Okay, hello everybody. Colby Wright again. Our topic today is using multi-factor models to assess investment performance. Here's our threshold question. How can we assess and attribute investment performance using multi-factor models? As usual, let's dive right in and see if we can crank through this. I want to do a brief review just to sort of set the stage for what our topic is today. You remember we've talked in previous videos about a simple potential decomposition of total returns. Again, setting the stage, I want you thinking about a portfolio, an actively managed portfolio. What we're now trying to do is we're trying to assess whether or not this portfolio manager is demonstrating any sort of investor acumen. So what we want to do is we want to try to attribute or describe or figure out where these returns are coming from. What we proposed in those previous videos is this, again, really simple potential decomposition, arguing that some of those portfolio returns should certainly be attributed to the risk-free rate. Probably a big chunk of the returns to any portfolio are simply a function of the risk that the portfolio has assumed. And then potentially there could be some elements of the return to an actively managed portfolio that come from acumen or from luck. The case study that we used was this WAMCX, this small cap growth fund from Wasatch Advisors. Just as a reminder, this thing has done really well. So I have a 10-year period from 2010 to 2019. If you had invested $10,000 at the beginning of 2010, 10 years later, you would have had $47,785. This compares really favorably to what you would have earned if you had put it into the S&P 500 ETF, SPY. If you had done that, you would have only wound up with $29,971. I guess I shouldn't say only. That's actually still really good performance. You've almost tripled your money in the span of 3 years. But man, with this WAMCX, you really would have killed it, almost growing your portfolio to $50,000. I showed you a breakdown annually. And again, this is just further evidence suggesting that this WAMCX really did perform quite well on sort of a nominal, just first blush analysis. Well, in one of the earlier videos, we talked about, well, maybe that's not a great way to think about assessing performance. If we really believe in this decomposition, that the returns to this WAMCX are partially attributable to the risk-free rate, probably a big chunk attributable to risk, and then there may be some acumen and some luck. One of the things that we proposed in a previous video was, well, shoot, let's just take these total returns and scale it by the most naive measure of risk. And the most naive measure of risk is simply standard deviation, right? Volatility. So we did this, again, using continuously compounded returns, just to jog your memory from that previous video. When we did this, we found that the average annual return to WAMCX was 15.52%. Average annual return to the S&P 500 ETF, 13.04%. But when we scale those by standard deviation, which is a measure of volatility, a measure of total risk, what we see is that on a very naive risk-adjusted basis, the performance of this WAMCX does not look quite that impressive. And just as a reminder, if I'm an investor, I want higher returns, lower risk, right? So I want this ratio to be as high as possible. And you can see that actually, when we do the scaling, the S&P 500 actually looks a little better than WAMCX. Okay, so that was the first baby step that we took into the world of performance assessment and attribution when it comes to actively managed portfolios. Well, the next step that we took, which was a much bigger leap, was to use the capital asset pricing model. I'm not going to go back through the whole intuition behind the model. Let me just simply start by saying what the capital asset pricing model asserts is, if we believe in this decomposition, right, that these are the four elements of returns to an actively managed portfolio, well, it's just making explicit, it's just explicating this relationship, right? So what we're saying is part of those returns come from the risk-free rate. Part of those returns come from risk. And I want to remind you that in a CAPM world, the only risk that gets rewarded is systematic risk. And what you've got here in this second term is, Inside the brackets, we call this the equity risk premium. That is the return or the premium for bearing average systematic risk. We scale it by the amount of systematic risk in the portfolio, which is captured by beta. So when we take the equity risk premium, scale it by the beta of the portfolio, that should be the returns of the portfolio attributable simply to systematic risk. Okay, so we've got the risk-free rate, we've got risk. Anything left over, we would have to attribute to either acumen or luck. Then if you remember what we did in order to operationalize this thing is we just reconfigured the formula a little bit. We took the risk-free rate and moved it onto the left side of the equation. And then we took this epsilon term and put it as the first term, and then we relabeled it alpha. So we're just moving some things around, and it took this form. So what we were saying is, if you took the returns to the portfolio, subtracted out the risk-free rate, and then ran a regression, so the left hand or the Y variable would be the returns to the portfolio minus the risk-free rate. On the right-hand side, the X variable would be the equity risk premium, the return on the market, minus the risk-free rate. And I want to give you just a brief reminder, in a CAPM world, that market portfolio theoretically should contain all the tradable assets in the world. That's your right-hand variable. Run a regression. Then what you're going to get is you're going to get an alpha estimate and you're going to get a beta estimate. That beta should be an indicator of the amount of systematic risk that's in the portfolio, and the alpha that you get from running this regression should represent the returns to the portfolio attributable to either acumen or luck. And again, a big reminder, you've heard me say this many times in previous videos, we're going to have a really hard time disentangling acumen from luck. This is about the best we can hope to do. Well, when we did this on a monthly basis over that 10-year horizon, right, we took the returns to WAMCX every month, subtracted out the risk-free rate. We took the return to the market every month minus the risk-free rate. We estimated this regression. We got an alpha. We got a beta. What did it look like? So right here's WAMCX. What was the result from running that CAPM regression? Most importantly, notice that the beta is minus 0.0355%. So that's 3.5 basis points minus 3.5 basis points on a monthly basis. But look at the p-value. The p-value is 95%. Let's remind ourselves how to interpret that p-value. What that says is, what we're dealing with here is a sample. This is simply a sample. We want to know about the population. If the population alpha was 0, then there is a 95% chance that we could get an alpha estimate in our sample as big in absolute terms as what we actually got. So in other words, there's a pretty good chance that alpha in the population is actually just 0. So our conclusion is there is no alpha. And if there is alpha, it might even be negative, which is not what you want. So what I'm trying to show you is, even on a naive basis, even when we just did Sharpe race, so we just took returns and divided by total risk measured as standard deviation, this mutual fund started to not look as impressive, right? The S&P 500 ETF actually did better on a return to standard deviation basis. We now are taking it a step further, and we're saying in a CAPM world, there is no alpha. Even though this fund has a really impressive nominal return, we cannot attribute any of it to acumen or luck. All of it can be attributable to systematic risk. So specifically, this fund has a higher than average exposure to systematic risk. So what we can conclude is the reason this portfolio did so well over that 10-year period is because it had a really high exposure. It had stocks in the portfolio that had higher than average systematic risk, but they held those stocks during a period of time where that worked, where holding high-risk stocks paid off. Okay, we're going to take it another step further today. That was just a brief review of where we've come from. Want to make more progress, capture more ground today. So I want to return to the simple decomposition of total returns, right? Part of those returns are risk-free rate, part are systematic risk, part is acumen, part is luck. That got us to CAPM. This is all stuff that I just showed you in the last couple of minutes. This all works, CAPM works, if we make the assumption that the only risk that gets rewarded is systematic risk. But what if it looks more like this? What if systematic risk is not the only risk that gets rewarded? What if there is some type, or maybe multiple types, of idiosyncratic, unsystematic risk that gets rewarded? If that's the case, this is our new portfolio return decomposition. Yes, still part of those returns would be risk-free rate. Yes, still part of those returns would be coming from exposure to systematic risk. Yes, there could still be acumen. Yes, there could still be luck, but now some of those returns might also be coming from exposure to idiosyncratic risk. Well, that poses a problem in a CAPM world. See, CAPM views the world this way. If we just run this regression, then alpha is acumen and luck. But if this is reality, if idiosyncratic risk also gets rewarded, then this is actually what you're doing in CAPM. You might get a positive alpha, but that positive alpha might not be a signal of acumen or even luck. You might simply be capturing returns that are simply a function of exposure to idiosyncratic risk. That's a problem, and we've got to try to figure out a way to deal with it. Okay, so over the last 30 or 40 years, financial economists have been doing lots of work in this area. This was especially big in the 90s. And what happened was researchers started creating portfolios that didn't seem like they took very much acumen. It didn't seem like there was any skill at all involved in these portfolios. And yet these portfolios started generating consistent CAPM alphas. So what I'm saying is researchers put together portfolios that didn't take hardly any skill, and when they ran the CAPM regressions, they were getting positive alphas. Well, if that's the case, you create a portfolio that doesn't take any acumen. Do you really want to say that that positive alpha is somehow acumen? Probably not, because you know that creating the portfolios didn't take any skill. Well, you could attribute it to luck, but this stuff started to be consistent. So if you make a portfolio using a very basic trading strategy and it consistently shows you a positive CAPM alpha, you know you can't call it acumen, but do you want to call it luck if it's consistent? Nah. Most researchers came to the conclusion that probably that portfolio is somehow reflecting some sort of idiosyncratic risk. That portfolio is simply capturing the returns to having exposure to some sort of idiosyncratic risk that does get rewarded, but isn't captured in systematic risk. So let me show you just a few of these portfolios. I'm going to give you a list of 4, and then we're going to dive deep on 2 of them. Okay, the first portfolio, this was especially big in the 80s, that seemed to generate positive CAPM alphas is simply called SMB. Small stocks minus big stocks. We're going to do a deep dive on this in just a second, so I'm going to move forward. The second one is called HML, high book-to-market stocks minus low book-to-market stocks. Again, we'll do a deep dive, so hang tight. The third one is RMW, robust minus weak. The idea here is high operating profit stocks minus low operating profit stocks. And then the last one I'm going to put in front of you is CMA, conservative minus aggressive. The idea is low investment stocks, meaning companies that don't do a lot of investments, CapEx specifically, minus high CapEx or high investment stocks. Okay, these are the 4 portfolios. And again, I'm going to do a deep dive on SMB and HML to try to help you understand this a little bit. But the idea is these are portfolios that financial economists created without using very much skill, without using very much acumen, and these portfolios seem to, on a consistent basis, generate positive CAPM alphas. We don't want to attribute that to acumen. We don't want to attribute that to luck. We're starting to believe, starting to conclude that those portfolios are simply reflecting idiosyncratic risk factors that are being rewarded. Okay, again, for simplicity, we're only going to cover the first two, and I'm going to dumb this down a little bit just to make it a little bit more accessible. Before we get there, we have to have a really brief digression on short selling, because short selling is going to become a critical component or a critical mechanism that we will use to create these portfolios. So how does short selling work? And I'm just doing a 30-second hand wave at this thing so that you'll get the main point. Here are the basics. Just follow the steps. 1, 2, 3, 4, 5. In step 1, a short seller borrows shares of stock from a broker. So we're using ABC stock. So that's step 1. A short seller borrows 10 shares of stock. You need to realize what that means. The minute the short seller borrows 10 shares of stock, that means at some point they have to give the stock back. They've created a stock debt. Not a dollar debt, a stock debt. Okay, short seller borrows 10 shares of ABC stock. Step 2, immediately, the short seller sells those 10 shares of ABC stock for $500. Okay, at that point, and this is really, really important for what follows, the short seller has borrowed 10 shares of ABC stock and has immediately sold them for $500. Key point: when you enter a short position, you get cash. That's a key point for what follows. When you enter a short position, you immediately get cash. You borrow the 10 shares, you sell it for $500. Then you hope, the whole idea with short selling is, you hope that the stock loses value. In this example, let's assume that that happens. Let's assume that the market value of those 10 shares drops from $500 to $400. Now you move to step 4. After the stock has lost its value, you go back into the market. Remember, you're sitting on $500. When you entered the short position, you got $500. You take that $500, you go back in the market, you buy those 10 shares, but now you only pay $400. So now you're holding in your hand not $500, you're holding $100 and 10 shares of ABC stock. That takes you to the last step. You take those 10 shares of ABC stock, you return them to the broker, and at that point you have cleared or covered your short position. You're out of the stock, you're out of the position, and you've made a profit of $100. I'll show you in a second why this matters, but what I need you to remember is 2 things. When you enter a short position, it creates cash. Secondly, through that short position, you will earn the inverse of whatever that stock earned, right? In this case, you bought ABC stock for $500. It dropped by $100. So the stock price went down by $100. It had a loss of $100, 20%. But you actually gained $100 because of your short position. So even though the stock dropped by 100, you profited by 100. So those are the 2 key things about short selling that you're going to need to understand as we move forward. When you assume a short position, it creates cash, and you will earn the inverse of whatever that asset earns. Okay, now we can talk about these portfolios that have shown a tendency to generate positive CAPM alphas. Let's start with SMB, small minus big stocks. Here is the basic idea behind this portfolio. The portfolio gets constructed at the end of June each year. And I want to reiterate what I said earlier. I'm doing a watered down explanation of what SMB is. When we get to the end of this, I will not have presented to you precisely what SMB is, but you'll get the essence of it, which is what matters to me. So I'm keeping it super simple. But imagine at the end of June each year, we're going to construct the portfolio. We're going to use all the stocks on the NYSE, Amex, and NASDAQ, and we're going to rank them based on the market value of equity. Let's just call this markup. So that's the thing. At the end of each June, we just rank all the stocks based on market cap. Then what we're going to do is we're going to assume a short position in the largest stocks, defined as stocks in the top 30% of all stocks based on market cap. So we're going to short the top 30%, the biggest stocks. Then and remember, if we short those stocks, that creates cash. So now we're sitting on cash. The next step then is to use that cash to assume a long position in the smallest stocks, defined as the stocks in the bottom 30% of all stocks based on market cap. So we go long in those small stocks. Note, this creates a zero investment portfolio. By shorting the biggest stocks, we get cash. Then we use that cash to go long in the smallest stocks. Also, notice that the returns to this portfolio will be whatever the average returns are to the small stocks, we will earn that, plus we will get the inverse of whatever the large stock returns are because we're short in those. And remember, if you have a short position, you get the inverse of whatever the returns are to the underlying asset. That's why the portfolio is called small minus big. By doing this long-short portfolio where we're long in the small stocks, short in the big stocks, we're going to earn the returns to the longs, but you have to subtract out the returns to the small or to the big stocks. So we're going to earn the returns to small stocks through our long position, but then you have to subtract out the returns to the big stocks because that's our short position. This is why it's called SMB. All right, now let's do high minus low, and then I'll actually show you some data. High minus low, this is how we're going to construct the portfolio. Again, it's going to happen at the end of June each year. We're again going to use all the stocks on the NYSE, Amex, and NASDAQ. We're going to rank them based on the market value of equity. Actually, that's a mistake. I'm sorry. We're going to rank them based on book to market, right? We're going to rank them based on book to market. So we're going to have the highest book to market down to the lowest book to market. Then what we're going to do is we're going to assume a short position in stocks with the lowest book to market, defined as stocks in the bottom 30% of all stocks based on book to market. So we're going to assume a short position in these low book to market stocks. That's going to create cash. We're going to use the cash to assume a long position in stocks with the highest book to market, defined as stocks in the top 30% of all stocks based on book to market. And when we say book to market, we just mean book market of value, the book market of equity on the balance sheet relative to market cap. The book value of equity on the balance sheet relative to market cap. So we're going to go long in stocks with the highest book to market. We're going to short stocks with the lowest book to market. Again, this creates a zero investment portfolio because we're getting cash from assuming a short position in those low book to market stocks. We use that to assume our long position in the high book to market stocks. What does that mean? Since we're long in high book to market stocks, we're going to earn the returns to those stocks. But since we're short in the low book to market stocks, we're going to earn the inverse of the returns to those stocks. That's why the portfolio is called high minus low. We actually get the returns to the high book to market stocks, but we get the inverse of the returns to the low book to market stocks. Okay, so this is how you construct. And again, I've simplified it. This is not exactly right, but I just wanted to do this in a way that would be easy to understand. Okay, so let's focus on this HML and let's come back to CAPM, right? What we're saying is CAPM says take the return to a portfolio, subtract out the risk-free rate, regress that onto the equity risk premium. This alpha in a CAPM world would be an indicator of acumen and luck. But what we're saying is if you create a portfolio that's this easy, I hope you can see there's not hardly any acumen that goes into this HML portfolio. Literally once a year, rank stocks based on book to market, do a really quick long short portfolio. And what we're saying is that portfolio has a tendency over time to consistently generate positive CAPM alpha. Look, we don't think that's acumen. And we don't think that's luck. we think that probably signals that that portfolio, that HML portfolio, is probably reflecting an underlying idiosyncratic risk that's being rewarded. So when we do this, when we actually take the returns to HML, subtract out the risk-free rate, regress it on the equity risk premium, let me give you an example of the results. So the results I'm going to show you are for a 5-year period from January 2000 through December 2004. Here are the CAPM results. Notice there's some really fascinating stuff going on here. Notice that the alpha is 89 basis points. That's almost 1% per month. Notice further that the p-value is 8%. How do we interpret that? If the population alpha was actually 0, there is only an 8% chance that we would get an alpha this big in our sample. In other words, it's very unlikely that the alpha is 0. It is much more likely that the alpha is actually positive and statistically significant. So this is the problem, right? CAPM says, wow, that portfolio must have a lot of acumen or luck in it, but we don't really buy that. We don't really think that that portfolio involves much acumen. It's not that hard to create. And we don't think it's luck because it's too persistent. Luck shouldn't persist. We think this is far more likely. What we're capturing in that alpha is that this portfolio, HML, reflects underlying idiosyncratic risk that's captured in stocks. It's reflected in stocks with high book to market. So if that's the case, if we think that what we really have is a portfolio that reflects underlying idiosyncratic risk, we do not want to rely simply on CAPM. If you rely simply on CAPM to engage in the assessment of actively managed performance, if that's how you're going to do it, if you're going to assess the performance of actively managed portfolios simply using CAPM, you might find yourself in this pickle. You might find a positive, consistent alpha that's not really acumen, it's not really luck. It's actually a reflection of idiosyncratic risk that the portfolio manager's loading up on. You don't want that. So what we do is we actually take the HML portfolio and the SMB portfolio and we add it to the CAPM equation. So what we're going to do is we're going to take an HML portfolio and we're going to add it as an explanatory variable. So it's going to look like this. We're still going to take the returns to our actively managed portfolio and subtract out the risk-free rate. We're still going to regress it on the equity risk premium. The beta to this explanatory variable will still represent exposure to systematic risk. But what we're also going to do now is we're going to throw in the small minus big portfolio, the returns to that portfolio, and the returns to HML, and there should be a subscript T right there. So we're going to throw in the returns to small minus big, and we're going to throw in the returns to high minus low. Why? What we're saying is, I want you to understand this. What we said earlier is that this equity risk premium, that is the premium above and beyond the risk-free rate for bearing average systematic risk. Then we're going to scale it by the amount of systematic risk. What we're now saying is that the returns to this high minus low, which is a zero investment portfolio, and that's, by the way, why we're not subtracting out the risk-free rate. Since it's a zero investment portfolio that generates positive CAPM alpha, we're operating under the assumption that just like the equity risk premium is a reflection of systematic risk, the returns to the HML portfolio are likewise a reflection of idiosyncratic risk that's contained in high book to market stocks. Similarly, the SMB portfolio is a reflection of idiosyncratic risk that is contained in small stocks, since that's what SMB is, right? It's a portfolio that loads up on small stocks. HML is a portfolio that loads up on high book to market stocks. Then what we want to do is scale it by their respective betas. Now, we have to be a little careful here with these beta interpretations. With CAPM, an asset that has average systematic risk would have a beta of 1. That's actually not the case over here. What I mean by that is a portfolio that's neutral when it comes to stock size. So if there's a portfolio that doesn't tilt towards small stocks, it doesn't tilt towards big stocks, it would actually have a beta of 0. So anything above 0 means this is a portfolio that tilts towards small stocks and therefore the risk in small stocks. Any portfolio with a beta less than 0 means it tilts towards big stocks and away from small stocks. Similar interpretation over here. Since the high minus low portfolio is a 0 investment portfolio that is long and high book to market, short and low book to market, any portfolio that's neutral on book to market, so any portfolio that doesn't tilt one way or the other on book to market should have a beta of 0. Any portfolio, however, that loads heavily on high book to market stocks would have a positive beta. Any portfolio that tilts away from high book to market stocks would have a negative beta. So we can think about what these betas mean, right? The next step is to interpret betas. So this beta right here represents the exposure to systematic risk in the portfolio. 1 is average, above 1 is high exposure. This beta SMB represents the portfolio's exposure to small stocks. Anything above 1 represents above average exposure to small stocks. This beta HML represents exposure to value stocks or high book to market stocks. Anything above 0 represents above average exposure. Okay, let me show you how to do this in practical terms. So here is our WAMCX, just reminding you of the impressive performance. What I'm going to do is I'm going to come over to the file now. Okay, so what we have here is we have, and by the way, this is referencing our previous video about assessing portfolio performance using CAPM. When we did that, I had already collected the data for WAMCX minus the risk-free rate, and we had already collected data for the market minus the risk-free rate. I want to remind you that the data that you need can be found on Ken French's data library. So if you come to Ken French's data library and you come down here to the FAMA French 3 factors, this is where you get the data. I've already downloaded that. I have it right here in my Excel file. So now what I'm going to do is I'm going to get the SMB data for the dates, and I'm going to get the HML data for the dates. Again, I'm going to use my VLOOKUP function. I'm going to look up my date, which I've already put into the same style as the FAMA French data. So I'm going to look this up back here. We're doing SMB, so it's going to be the 3rd column. I'm going to march that all the way down to an absolute reference, 3rd column, and I want an exact match. And remember, you have to divide that by 100. All FAMA French data is in integer format, so you have to divide it by 100. Turn that into a percent, and we now have SMB. So notice, in December of 2019, the SMB portfolio, which is long in the smallest stocks, short the biggest stocks, returned 68 basis points. We're going to do the same thing for HML. I'm going to do the VLOOKUP, looking up the date, coming back here to the FAMA French data, going all the way to the top. Now it's going to be the 4th column, absolute reference, 4th column, and again, we want exact match. Don't forget to divide that by 100. Turn it into a percent, and send that all the way down the line. Okay, we have everything we need now. So we want to execute, just to remind ourselves, we want to execute. Sorry, one second, I'm trying to get to the right file. We want to execute this model right here. We want the returns to our portfolio, WAMCX, minus the risk-free rate on the left side. we want the returns to the market minus the risk-free rate, the returns to the S&B portfolio, and the returns to the HML portfolio. We want those as our three explanatory variables. So I'm going to come back to my Excel file here. We're going to go ahead and do our data analysis. We're going to do regression. We'll go ahead and highlight all the data here. And again, I'm going to highlight these three. And I've got labels on mine. So we click OK, and it's going to give us the output. I've actually dropped this into Excel. So I'm going to go back into our Excel. I'll be able to see this a little bit bigger. So here are the results from our regression. First off, notice alpha is minus 0.08%, so negative 8 basis points with a p-value of 88%. Interpretation, if the alpha in the population is 0, there's an 88% chance we could get an alpha this big in absolute terms in our sample. In other words, alpha is probably 0, and if it's not 0, it's probably negative. So that means no acumen, no luck. Okay, the beta in front of the systematic risk is 1.03. P-value is 0, which means it's statistically significant. In other words, now that we've actually controlled for, now that we've included both the SMB and the HML, it looks like this portfolio actually has pretty average systematic risk. Okay, so what we can say is a fairly big chunk of the returns to this portfolio are coming from exposure to systematic risk. Has a really big SMB beta. Remember, SMB and HML betas are different than systematic risk betas. The average systematic risk beta is 1. The average SMB and HML betas are 0. So a 0.73 SMB beta is very big. And what does that mean? That means that this portfolio has huge exposure to whatever the idiosyncratic risk is that's contained in that small stock portfolio. There is another way to interpret that. The other way to interpret it is this stock is just loading up on this portfolio is just loading up on small stocks. Let's look at HML. HML is big and negative, statistically significant at the 0% level. So this is really statistically significant. It's huge, but it's on the other side. So that means they're not loading up on high book-to-market stocks. They're loading up on low book-to-market stocks. Well, low book-to-market stocks are called growth stocks. So what we can conclude is this portfolio, although it performed really well, has no elements of acumen and luck to it for the most part. It's simply a matter of loading up on average systematic risk, a ton of small stocks in the growth category. This is what we mean when we say performance, attribution, and assessment. Here's what we mean by assessment. We don't see much acumen. The alpha is 0. When it comes to performance attribution, we know that part of their returns are coming from systematic risk. They have about average exposure to that. They have really high exposure to small stocks, and they have inverse exposure to high book-to-market stocks. In other words, they have big exposure to low book-to-market stocks, which are also known as growth stocks. So not much acumen, a fair amount coming from systematic risk, quite a bit of it coming from small stocks, and the rest of it coming from growth stocks. Wanted to try to help you visualize this just a little bit. And my graph isn't working, so never mind. We won't try to do that. Actually, let me see if I've got it in my Excel file. I don't, so we're going to have to call that good. What I was going to try to show you is if you compare this, actually, I will take the time to go and do this. So I'm going to come back here. Okay, so let me just do this chart real quickly. Okay, select data, S&B, edit. Sorry, this will take me just a second. So I just want to show you a comparison of SMB against WAMCX. Okay, the red line is the return to the SMB portfolio, long small stocks, short big stocks. Notice how WAMCX compares to this thing. Notice that when the SMB portfolio is up, WAMCX is up by even more. When the S&P portfolio is down, like right here, the WAMCX portfolio is down by even more. So that's what I'm trying to get you to understand is this method that I showed you using these multi-factor models. This allows us to do performance attribution. We know that because this beta on S&B is positive and significant, that this portfolio is heavily exposed to small stocks. This graph right here shows that to you visually, right? S&B is the small minus big portfolio. You can see that the WAMCX is positively correlated, but much more volatile than that. Okay, so I just want to remind you, this is multi-factor models. Now, one final note here before we close this up. This is what we call the Fama-French three-factor model. You're going to see five-factor models, four-factor models, but they're all going to follow the same logic. They're going to create some zero investment portfolio. That zero investment portfolio is going to show positive CAPM alpha. And when it shows positive CAPM alpha, we're going to make the assumption that that's not acumen or luck. That represents exposure to an idiosyncratic risk factor. So you're going to throw that portfolio into this equation and put a beta in front of it. So the logic that we use for the Fama-French three-factor model is going to also hold for 4 and 5-factor models. Okay, hope this is helpful. This is actually the last step that we're going to take. So just as a reminder, the first thing was we took total return and divided by standard deviation. That's essentially Sharpe ratio. The next thing we did was use CAPM to try to separate out acumen and luck from systematic risk exposure. Then this next step was to add in extra portfolios that might represent exposure to idiosyncratic risk in both small stocks and high book to market stocks. Hope that's helpful.